Hey, it's AI here, anonymous, so I can show you my accounts and not feel weirded out by it. We're up $11,000 today, and it's been a good day, can't complain. And you might have noticed from my other videos, because I always show my personal value of this account, and you can see and track every video, if it's going up, down, what's happening. And it just made a big jump. It went up like $600,000, right? I was at like 1.29 or something like that in the last video, right? So how the heck did I grow this portfolio by $600,000? And look at my 1 year change here, 3,674%. Man, I am definitely the best trader, probably on record, at 3,674% this year so far. Why does it say this? No, it's not actually. Those aren't real gains. That includes amounts deposited onto the account. So some of you guys were asking me about that. And why did it just jump up around 600K? Well, it's because I moved over our business's retirement account. So this is not just my account. So a couple other people are in this account, but it's around 600,000. And we moved it over from Merrill Lynch, which was a financial advisor at Merrill Lynch that was managing the portfolio. And I said, hey, we got to move this over because there's this truth about financial advisors, which I think a lot of people are missing out on and don't really understand the full story of what it means for their finances. And so it was actively managed at Merrill Lynch, and I moved it over so I can manage it myself, and it's in my Charles Schwab account now. So I want to talk about in this video why I left Merrill Lynch and what I'm doing instead. As you can see down here, pension trust, it's a retirement account, so we just moved in $599,000 to it. It's up $6,000 today and $4,000 in my personal brokerage account. So let's talk about why I'm leaving Merrill Lynch and the financial advisor. And if you're ever thinking about getting a financial advisor, this is probably a really valuable video for you. So stay tuned. If you want to see my other holdings, you can watch another video. Please like this video if you do and you appreciate me being super transparent and showing you all of my accounts, all of the actual transactions in them. As I buy, as I sell, I'll be making new videos, so make sure to subscribe so you can see and get notified in the moment. All right, let's get to it. Also, sorry that I haven't made a video recently. These videos are actually, they take time. So click like for that YouTube algorithm. I appreciate it. And let's get to it. So just a little bit of background. This is an email that I sent out to my company. I have a small business. It's all online. I'll be sharing how it works in a future video, and that's helps me actually create the income, obviously, that I'm using to invest. But this is an actual email that I sent my business partner saying, hey, we need to stop doing Merrill Lynch's financial advisory because the big fees dramatically eat the growth over time. Now, you can actually expect around a 1% fee for an active manager. So what an active manager is it's a financial advisor who is managing your portfolio. You can sign up with one pretty much anywhere, any bank. It's a big money maker. And basically what these financial advisors do is they manage your portfolio. So that means they're buying stocks, they're selling stocks, they're buying bonds, they're making guesses basically that they can beat the market, that they can do better than you, and that overall they can beat the market, and that's why they're active. Active means they're buying and selling actively rather than they just put you into one ETF, one exchange traded fund, and let it run. Two main things I'm going to talk about in this video. One is that these stock pickers, if you have a financial advisor, well, they're probably not as good at picking stocks than you realize. And the second thing is that fees can dramatically cost you a lot of money. And so if you have a retirement account, it's really valuable for you. If you're just investing in general, this is super valuable for you. Fees can cut into your overall growth by a massive amount. A 1% fee is typical for a financial advisor. So if you're looking at getting a financial advisor like Merrill Lynch, which is if you walk into Bank of America, they'll probably try to sell you on getting a financial advisor with Merrill Lynch. If you walk into Chase, they have their own program. If you walk into Wells Fargo, they have their own program. So these banks make tons of money off of selling this financial advisory package, and it's usually around 1%. Now, my financial advisors at Merrill were actually charging a lot. They were charging 1.5%, and I know that might not sound like a lot, like 1% or 1.5% might not sound like a lot, but it actually grows in massive ways over time. So you want to make sure you're looking out for fees at all times, because that's probably the biggest killer of people's retirement accounts or any active stock market account. Now, the idea of a active manager is pretty obvious, right? It's appealing in that you're going to get a pro to buy stocks for you, to sell stocks for you, and maybe it's going to result in higher returns, right? That's the idea. So the idea is that they're going to be able to beat the market. They're going to be able to do better than if you were to just buy into the market. So those fees are not a big deal, right? 1%, it's nothing. I can easily grow your portfolio by more than 1%. Now, here's the thing, though. Stock pickers are actually worse at picking stocks than you may realize, okay? So it sounds appealing to have this guy pick stocks for you. It's a pro. Man, I was so excited talking to the guy at Merrill Lynch when we first started like 5 years ago with him, because it's like you're talking to a pro, right? You're talking to someone that this is what they do. They eat, breathe, and live this stuff. And so I was pumped up that we were going to have a pro do all of our buying and selling and maximize our portfolio. I'm super big on maximizing success, and this seemed really obvious, right? But here's the thing. Active managers don't perform well. Passive funds overwhelmingly have better odds of not underperforming. So what that means in a weird sentence is saying active managed funds overwhelmingly do worse than passive ones, especially when you factor in the fee. Just how bad do these actively managed funds do on average? Well, in terms of all domestic funds, so just like the S&P, if you were to take that pretty much, in 5 years' time, there's a 97% chance of your passive fund doing better than an active manager. Okay, this was just in a 5-year span of the last 5 years. Here's a 10-year span, here's a 15-year span. Overall, though, the trend is that 15 years, there's a 95% chance that the active manager is going to do worse than if you were to just buy the S&P Composite 1500 or just the S&P 500. Boom, 95%. And as you look at all these different types of comparisons, they're all really high percent, right? 90%, high 90s, 100% for this one. So 100% of the funds do worse than if you just bought the S&P Composite 1500 growth. So those don't look good, right? To me, being in the 95 percentile, and that sounds good to me. I don't want to be in the 5 percentile, like where there's a 5% chance you're going to do better. That's not very exciting. And this might sound really strange to you, but Warren Buffett bet that hedge funds would lose compared to index funds. So hedge funds are actively managed funds that are buying, selling, and index funds are basically the overall market. So the S&P 500, you can buy the index of that, which I own, the VOO. It's actually one of my biggest holdings here, or it is my biggest, I think right now, 1,000 shares of VOO, so around $317,000 just of this. So it mirrors the entire S&P 500. So around 10 years ago, Warren Buffett took a $1 million bet, basically saying, hey, I'll donate $1 million to any charity if the main hedge fund managers can beat the index fund of the S&P 500. So the 5 hedge funds picked by a firm, Protege Partners, added an average of about 36%. And that's compared to 125% over the 10 years of just the S&P 500. The hedge funds got off to a fast start, beating the index fund in 2008, and then they lost every single year after that. The stock market does not require great intelligence. It doesn't require a degree in economics or a familiarity with Wall Street jargon. What investors need is the ability to disregard, to ignore mob fears, the mainstream fears, or the mainstream hype, and instead focus on a few simple fundamentals. Stick with big, easy decisions and issue activity. So that's really disappointing that the big hedge funds can't even beat the overall market. They're buying, they're selling, they're out of the market sometimes during times are good. They're buying in at the wrong times over and over again. This is what happens. Now, here's the thing with how fees work. So it's really important to understand the fee. So in this case, 1.02%, which I think was the average that they found for actively managed portfolios, it's taken out as a percentage of the portfolio's value. So the larger the portfolio, the more the investor pays, right? So that makes sense. So it's a 1% off your entire portfolio every single year. Number of years invested, 10 years, portfolio value lost to fees, 11,000. What about 30 years? $210,000. After 40 years, some of you guys are young, right? Most of you guys are between 25 and 35. So 40 years of investment, you've lost $592,000 from fees. That's freaking crazy. What's your total value, your after fee investment value? This is just an average that they came up with, around 1.77 million. So that means that your value lost to fees is 25%. That's freaking huge. You have a value of 1.77 and you basically put in $600,000 in fees. That's not good. It gets absolutely out of control because fees that are taken out, you have to realize the same way compound interest works or compounding in general works, where if you make 1% 1 year and you're at, let's say, $100 portfolio value, you make 1% and then you're at 101, and then you make 1% next year, you're at more than 102. You're at 102.1 or something, right? So it increases every single year because it compounds. This is the opposite. This is a compounding loss to your account. The 1% fee gets taken out. So instead of that 1% growing your portfolio every single year and compounding growth, it's taking it out from it. That's how this amount gets so big over time. And another way to think about it is it's not just money lost to fees, it's also time. Because you could have maybe retired 5 years earlier, 10 years earlier if you didn't have these fees. If you could have had the same results in the market compared to your hedge fund, then this would have been $600,000 extra dollars. So that's literally like 6 years of retirement at $100,000 a year of spending money. Not to mention the fact that these managed funds do worse on average. So you are losing way more than just the fee amount. This is actually an email that I use to convince my business partners to try to get out of Merrill Lynch. And I created this whole graph here, and it's the fund's results over time. And I think with a contribution of $50,000 a year, at a 7% investment earnings with a management cost of 1.5%, our fund was going to end at $3.9 million instead of $5.2 million. We would have had $1.4 million of fees, which is absolutely insane. Not to mention that, again, it would have probably underperformed than if there weren't any fees and it was passive investing. So in all of that, as you can tell, I'm passionate about this information because it's absolutely crazy what's going on in the world. Most people do not understand this and don't see how bad these fees can be. And the fact that these actively traded managers don't even beat the market, like the average of the market, it's a really crazy thing that happens where there's still billions of dollars going to it. Now, active management doesn't mean it's all bad. You could have an active manager where you are in charge of a small fee, let's say like 0.5% or under. Vanguard has active management, I think, at 0.3%. So maybe you can justify that if you don't want to touch anything and you want someone else to do it for you. Just make sure that they're also buying exchange-traded funds. Okay, they're not buying expensive mutual funds, which also have fees. Also, make sure they're a fiduciary. So if you're looking into an active manager, make sure they're a fiduciary. Ask them that. What that means is they are exactly aligned with your own interests. So they're not going to buy a stock because they get an extra kickback, like a commission, which happens a lot. They can only buy what they think will help your portfolio, and they have no benefits to do anything otherwise. Also, you want to make sure they're a CFP. That's the gold standard for financial advisors. They've had to take pretty much the highest level of testing and the highest educational requirements. Hopefully this helped clear the air and explain why I'm a big fan of passive investing. That's what I share in this channel, is not going through a fee manager, but instead investing on my own through passive ETFs, exchange traded funds. I'm going to be sharing in an upcoming video, maybe the next one, what I'm going to be doing with those $600,000 worth of stocks and bonds. I'm actually going to be selling them all and buying something with them to make our portfolio stronger, simpler, and maximize the results. So subscribe if you're interested. Thanks so much, and I'll talk to you soon.